Why would you do that? It makes absolutely no sense. What's going on, everybody? My name's Edgar, and I'd like to welcome y'all to my new YouTube channel, Edgar's Money Mind. Let's get right to it. I understand that buying a car is going to be one of the biggest financial decisions that you make in your life. So I want to make sure that I give you 5 tips today to make that car buying process just a little bit easier. Tip number 1, and by all means, do not make this mistake, and that is buying a new car. Yeah, I said it. A lot of people are going to give me a lot of stick for that.
Yeah, this guy doesn't know what he's talking about. He's just a YouTuber. He doesn't know what he's doing. He's unsubscribe, unlike.
Now, what a lot of people don't realize when they buy that new car is that as soon as they drive it off the lot, that car drops about 11% in value on average. So let's do some quick math here. If you purchase a car for $20,000, that means that as soon as you drive it off that lot, that car is going to drop $2,200. And that's not even the worst of it. By the end of the first year, that car is going to drop, on average, 20%. That's a difference of about $4,000 from the initial purchase price. What you should do is purchase a used vehicle instead, preferably something around 2 or 3 years older, still under warranty. I personally prefer to purchase something under 50,000 miles. Now, there's no way that you're going to be able to completely remove the depreciation, but at least you can slow it down quite a bit by buying that used vehicle instead of the new one. Of course, there are a couple of exceptions. That is, if you happen to purchase an antique vehicle or if you purchase a collectible, then of course it may even appreciate in value. Tip number 2, and that is focusing too much on a lower monthly payment. Now, what I mean by that is people typically tend to focus way too much on their monthly payment, but what they fail to take into consideration is how long those terms are actually going to be for. I've sat down with plenty of clients who have gotten into 72-month, 84-month, 96-month deals with very low monthly payments, but they're barely budging the principal, which means that over the long term, you're going to be paying astronomically more in interest just by having those lower monthly payments. I sat down with a client once and had a conversation about his vehicle to see if we could save him some money. Now, the problem that he had was that he ended up into an 84-month term who, by the end of the deal, was going to end up paying double the original value of the vehicle. He believed that the payment that he got into was something that he could afford, which leads me to the 3rd tip. Do not spend more than 10% of your monthly net income on your monthly car payment. I've read quite a few articles explaining that you should take the gross income into consideration. But you have to remember that your net income is what you're actually taking home. For example, if your take-home income is $2,000 a month, your monthly car payment should not exceed more than $200 a month. I've met quite a few people that have ended up getting into car payments of over half of their monthly take-home income. I've even had some that are paying as much as their mortgage on that car payment. Why would you do that? It makes absolutely no sense. I'm just absolutely baffled that somebody would actually agree to pay that amount for their car. And what makes me even more upset is that that person selling you that car knows your financial situation, yet they don't care. They're getting paid. If you were following this rule, you could take that extra money and put it towards your 401k. You could put it towards renovations on your home. You can put it into a high interest yielding savings account. Or if you don't have any one of those, or if you want to grow your money even more, you could put it into the stock market. Just remember that there are risks for that. But it's better than putting it all towards a depreciating asset. If you can even call it that. That's a liability. There are ways for you to be able to turn that car into an asset, but we're not going to get into that today. So let's get into tip number 4, and that is not taking your insurance into consideration. Your car payment and your insurance go hand in hand. You can't drive your car without insurance. Legally, anyway. You have to make sure that your monthly insurance payments aren't more than about 5% of your take-home income. Now, you can stretch that out to about 7%, but you just want to make sure you have a little bit of wiggle room in case you have to do any major repairs on that vehicle throughout the year. And now let's get into my 5th tip. But before then, make sure you hit that like button and subscribe. This is something that most people actually forget to do until they're actually in the dealership. And what that is shopping for interest rates.
Yeah, but Edgar, I don't like having my credit pulled. It's just gonna bring my score down.
Now that's a valid point, random netizen. By the way, your glasses are a little dirty. What a lot of people don't know is that once you start shopping around for auto rates and you actually submit an application to qualify for one, the 3 major credit bureaus already know that you're shopping for those rates. So it's not going to affect your credit score as much as you believe. Before you even step into the dealership, you can actually go online and search on the major bank websites and be able to find the as low as auto rates for a used vehicle. The as low as rate is actually the lowest rate that you can possibly get if you are what the banks consider the perfect customer. You can also check with your local credit unions, and most of the time they actually have some very competitive rates, most of the time even beating those major banks. The only drawbacks to them is that sometimes they may have a fee for you to be able to process your payment, or you may have to be a member of that credit union to even qualify for a loan. I've actually had clients get into terrible interest rates just because they didn't do their research beforehand and tried to apply for a vehicle that's worth more than what they can reasonably afford. So what that means is whenever you do qualify for that loan, that person or that bank lending you the money is taking on a bigger risk, therefore increasing your rates. I want to make sure that you avoid getting into a predatory loan where you're paying a 10%, 15%, or even a 20% interest rate on that auto loan. Make sure that you just take a little bit of time out of your day to shop for those interest rates. That could be the difference between you paying a $300 monthly car payment or a $200 monthly car payment. You absolutely have to make sure that you do your research before you ever step into that dealership. That way you'll know what your monthly payments are going to be, you know what your interest rate is going to be, and you're going in there with a goal in mind. I hope that these 5 tips have helped you in making a better decision when it comes to purchasing your vehicle. Now, if you have any questions, feel free to leave a comment down below. You can send me an email or follow me on my social media. I'm going to leave all the links down in the description somewhere. And I hope you have an amazing day. Thanks for watching.